Thank you, everyone. Welcome. Really glad to have you all here. This is a joint event of the Rethinking Regulation program based at the Keenan Institute for Ethics at Duke University, of which I'm the co-director. I'm Jonathan Weiner, law professor here, and I co-direct that with Laurie Benier. It's a university-wide program. If you're interested in regulatory policy, regulatory institutions, the history or future of regulation on any topic, we would love to have you involved in our activities. And this is a joint event with the Global Financial Markets Center based here at Duke Law School. I'm really grateful to Lee Reiners, who's the director of that center, and Lawrence Baxter, and the other faculty involved in the Global Financial Markets Center for co-organizing this event. We are delighted to have with us a recent veteran of the battles in Washington over financial regulation, and a really person with a fantastically interesting series of experiences in both private and government work on financial regulation. Sarah Bloom Raskin. She got an undergraduate degree in economics at Amherst and then a law degree at Harvard. She served as counsel to the Senate Committee on Banking, Housing, and Urban Affairs, and also worked for a variety of private sector firms. But then, with amazing timing, in 2007, she became the Commissioner of Financial Regulation for the state of Maryland from 2007 to 2010, a period of enormous tumult, as you know, in financial markets. And then in 2010, President Obama appointed her to serve as a member of the Board of Governors of the Federal Reserve, where she served from 2010 to 2014. And after that, President appointed her, again with Senate confirmation, as Deputy Secretary of the U.S. Department of the Treasury, where she was second in command of the Treasury, responsible for the entire department, with also special focus on ensuring the stability of the financial infrastructure and consumer safeguards and cybersecurity. And I think Deputy Secretary Raskin, Sarah, is going to speak to us about all of those topics and also about issues in the potential changes to Dodd-Frank and other financial regulatory regimes looking ahead. So we're so grateful to have you here. Thank you for joining us. And I should say I should clarify, she's no longer Deputy Secretary of the Treasury, having served until January 20th, 2017. So that also perhaps offers in this informal setting an opportunity for some reflection and lessons learned, prospects for the future that a sitting government official might not be able to share. So we really look forward to your comments. Thank you, Sarah.
Thank you. I'm very happy to be here with you today at this lunch sponsored by the Rethinking Regulation program and the Global Financial Markets program. And of course at a gathering that includes academic expertise that spans the law, public policy, history, economics, science, national security. It's always impressed me when I see institutions able to gather and bring together different realms of expertise and perspective in service, really, to the creation of new ideas that may live really in the intersections of traditional disciplines. So you've invited the right person to talk to you today, because indeed it has been my experience that our financial policy challenges rarely live anywhere except in the intersections. In my experience, the challenges emerge in the seams, and their solutions emerge in the seams. And so, while policymakers need to be tapping into the deepest expertise they can find on any given topic, at the same time, they need to be nimble enough to recognize that the experience, the expertise, the inspiration may exist somewhere else entirely. And then they need to corral that expertise, pulling in from that somewhere else into their web of working thought. And really, it's only in this way, with this method, that there's any hope at all of getting close to a comprehensive understanding of some of our world's most vexing financial challenges. So this is really a long way of saying thank you for inviting me. Your approach is exactly the right one for dealing with our myriad policy challenges today. I have indeed constructed my own approach to policy in my years of doing it to not be unlike yours. So really bravo for creating interdisciplinary homes with the academic power to move our understanding of financial challenges forward. So Jonathan was kind enough to ask me to reflect a bit on my tenure, both as a governor of the Federal Reserve Board and as the #2 at Treasury, which is the role of the Deputy Secretary of the Treasury. And as Jonathan noted, I went from the Federal Reserve Board to Treasury. And, it might be historically unprecedented to have had your hands on two sets of levers, the monetary policy lever and then the fiscal policy lever, especially during an active period of responding to and building a recovery from the financial crisis. And as I think back on these 7 years, I'd say that to be a Fed governor is challenging and awesome, and to be running the Treasury Department is challenging and not so awesome. But I'll talk more about that distinction later. My plan here really is to provide some observations about my time at the Federal Reserve and at Treasury, but of course to save time to hear what is on your minds and to take questions and comments from you and develop some of my observations more thoroughly. I'm not speaking from any official capacity. Indeed, the shackles have been unlocked, and so I welcome really a full and frank discussion at the end of these remarks. And in addition, I hope that these observations are of interest not just to those who study financial and market regulation, but those who consider regulation more broadly, indeed in all of its various aspects. So when I reflect on my time as a public official, it's worth remembering that this time was a period in our country's economic history where we were in a recession. Of course, this was the deepest and longest recession since the Great Depression, and the recovery had really not yet emerged. By the time I went to the Fed in 2010, the unemployment rate was still high. It hadn't really budged much. Inflation was low. It was almost a deflation. Loan demand was low. And we had yet to ponder whether the most extraordinary of monetary tools, some of which had never been used before, would be of any use. And we also had yet to ponder whether a comprehensive set of regulatory changes would bring about a stronger financial sector capable of supporting economic growth. And for me, two levers, the monetary policy lever and the fiscal policy lever, had not been levers that I had extensive history with. Indeed, the bedrock of my career had been as someone who has been a financial regulator. And it was therefore the regulatory lever that was most comfortable in my grasp. So this regulatory perspective, it turns out, was pretty important in 2007 and onwards because, of course, these were the years of the financial crisis, which was a crisis of many dimensions, but one of which was a crisis in the functioning of the regulatory apparatus. And the prevailing view of those days was that the financial crisis was a failure of banks, primarily, and that the bank regulators had themselves failed on the job for letting the banks fail so miserably. So when I was appointed to the Fed in 2010, after having been a state regulator in Maryland from 2007 to 2010, I was quite certain that my perspectives on regulation were going to be needed and relevant and timely. I knew that what I had seen at the local level of the state, the boarded up homes, the calls to complaint lines, the defaulted and delinquent loans, that those were experiences that were not the same of those of my new Board of Governor colleagues. If you think back to 2010, there was a high degree of uncertainty about what exactly had caused the crisis to occur and how the various tools, monetary, fiscal, and regulatory, should be optimally combined and timed to restore confidence to the economy. Indeed, if you go back and read the transcripts from the Federal Open Market Committee meetings during that time, you'll see the contours of an atmosphere that feels uncertain, not particularly confident, insecure, somewhat skeptical. The plunge in economic activity had happened, and commerce and economic activity had all but stalled out. Banks were not lending, businesses were not borrowing, firms were not hiring, houses weren't being bought and sold. In fact, foreclosures remained at an all-time high. And knowing exactly how to restart the engines, or more precisely, how to restart an engine that you were unsure of how it would perform, when it was turned on, was far from certain. These were not usual times, and there was a palpable sense that at that time that usual times may not be right around the corner, or that when they returned, they would not be the same, that the longer we lingered in the depths, the more we would veer from normal reactions and relationships that economists certainly had come to understand were basic economic behaviors. The way to think about this is if your parents, grew up during the Depression, it's often said that their behaviors are such that they do particularly thrifty things, like reuse their dental floss, things like that, But, similarly, when young people saw their parents lose their family homes and wrestle with mortgage servicers over trying to restructure their mortgages, we wondered whether they would ever view homeownership as a form of wealth and whether American homeownership would again have a place in the American dream. So after each FOMC meeting, in which more accommodation, more monetary accommodation had been provided or signaled, Chairman Bernanke would get ready for the press conferences, and the governors would go into the little library, which had become our TV room, and we would watch the press conference, and we'd watch the dual screen, right? On one side is the press conference, on the other side is the market reaction, the market movements. And we were watching to see whether the markets were moving as we thought they would, and whether the words that we had crafted so carefully were having their intended effect, or whether they would, boomerang inexplicably and create confusion. This was not a science with perfect predictability. And of course, the markets were not what we call the real economy, the part that has to do with jobs and wages and buying and selling and investing. Those markets, those real features of the economy had to react in a sustained way and not a sputtering, half-hearted, weak or non-existent way. And those reactions would not happen until well after the press conference. But I dwell on those years, not so much because I'm obsessive compulsive, which I am, but because despite the fact that we emerged from the financial crisis successfully, these tools worked. They all did. The monetary policy levers, the fiscal policy levers, and the regulatory levers. Now, they were not perfect. And you can argue, for example, whether quantitative easing was perfectly calibrated in terms of the amount set for each amount of monthly large-scale asset purchases. You can argue whether the fiscal stimulus was large enough, whether Dodd-Frank was sufficiently prescriptive. But overall, these tools succeeded in putting the crisis behind us, the recession behind us, the high unemployment and high risk of deflation behind us, and the high foreclosure rates behind us. We would not have recovered from the financial crisis without them. And yet, but still, there were features of that crisis that reverberate. There were fault lines, vulnerabilities, structural weaknesses that I believe are with us today. And I think about these vulnerabilities not just from the prognostication perspective. You know, it's great sport to be able to time the next downturn. I think about them because these vulnerabilities are manifesting themselves in other economic and financial contexts. Or stated differently, stated maybe in the vernacular of the historian, we are not taking on board fully the lessons learned. And it's these other contexts that I turned my attention to after leaving the Fed and moving to Treasury. And one such context was the growth in student loan delinquencies and defaults. Another such context was the financial stability risks emerging from cyber attacks to our payment systems. And I spent a lot of time at Treasury devoting attention to these areas, and we can talk about exactly how I did that. But my point right now is that this work was related to the fault lines and vulnerabilities that we had learned about in the financial crisis. Now, these fault lines and vulnerabilities are different from so-called headwinds. Okay, headwinds, you know, you hear policymakers talk about headwinds a lot. Headwinds usually come and then go. Fault lines and vulnerabilities are different from headwinds because they're the cracks and the fissures in the foundational structure that a recovery can cover up, but that are still present. And they don't go away on their own. And regardless of whether these vulnerabilities and fault lines become so pronounced that they result in another recession that, you know, has the magnitude of the last one, they have been, for me, matters of nagging concern. And I think of them as critical to our country's ability to prosper in a sustained way rather than in a sputtering way. So, you know, there's that old saying that when you have a hammer, everything looks like a nail. Well, the banks in particular have been most vociferous in believing that the hammers were aimed consistently and relentlessly and solely and unfairly on them. The banks would have us believe that the hammer of monetary policy brought them low interest rates that made it difficult for them to be profitable, that the hammer of structural policy in the form of Dodd-Frank regulated them in such a way that it became difficult to lend. Hence, their focus in Washington has been to limit the hammers, to take away the Fed's ability to discuss what may be needed behind closed doors, to take away the tools of designating institutions that present systemic risk, as discussed by the Financial Stability Oversight Council, to take away from the federal financial regulators the supervisory ability to look behind capital to see how banks are functioning, and to limit the ability of the consumer regulator to enforce the consumer protection laws. So I have two concerns. The first one is that government agencies need these regulatory tools. And maybe they can be refined a bit, no question, but they are still needed. The second concern is that this unending political focus on the tools distracts us from addressing our underlying vulnerabilities. So let me be specific about this second concern. There were and are explicit features of our economy and how businesses are organized in our economy that present vulnerabilities and continue to present vulnerabilities. And I have a running list of them. They consist of items like greater heterogeneity in income and wealth. In other words, the spreading out of income and wealth levels that make recoveries from downturns more protracted and slower. Another vulnerability is the greater interconnectedness of financial firms that make contagion and the spreading of risk more prevalent. Or the deterioration of compliance systems and internal controls within financial firms that make consumer harms more long-standing. Or the immaturity of such systems and controls within technology firms that make competition for better financial services more slow to emerge. Or the obsolescence of foreclosure processes and other judicial processes that erode trust in our system of laws. Or the outsourcing of financial functions to different firms that make cyber attacks more difficult to defend against. These are all examples of structural features that arguably the market cannot solve by itself without wreaking significant harm. These are the structural features that, in my mind, create vulnerabilities. So think about what certain of these vulnerabilities may point us to, especially if they coalesce simultaneously in such a way that they not only present harm in that perfect storm sort of way, but also if they later present these like tight knots that are obstacles in the confidence necessary for reviving and restoring growth. For example, have we sufficiently addressed the operational components of our disaggregated and outsourced financial sector to assure ourselves that our financial sector can protect us from debilitating and destabilizing cyber attacks to financial assets? Have we sufficiently evaluated the safeguards that might exist in financial markets outside of traditional consumer-facing banks? What about the financial products and services that are now part of the so-called fintech world? We know how traditional loans from brick and mortar buildings are to be overseen and the sets of controls that optimally are put in place regarding them. But what about loans that emerge from platforms rather than brick and mortar? What's our regulatory approach to them? Think of the example of servicing. Now, mortgage servicers are the firms that banks hired to collect the monthly payments of principal and interest on a homeowner's mortgage. We learned during the financial crisis that they were unable to service profitably when confronted with non-automatic tasks, like dealing with mortgage holders who couldn't make their monthly mortgage payments. Well, we are now seeing analogous servicing problems by student loan servicers who are confronted with student loan borrowers who can't make their monthly student loan payments. So these are all examples of vulnerabilities that we knew existed in the context of the financial crisis, but that beg to be understood in new contexts. It's like another old joke, so late one night, a policeman sees a man weaving around under a streetlight. "Sir, what are you doing?" the policeman asks. And the man walking under the streetlight says, "I'm looking for my car keys." And he's obviously drunk. And the police officer says, "Is this where you lost them?" And he says, "No, I lost them back there." The man replies, and he points over his shoulder to a dark area of the sidewalk. "But the light is better here." So, I have no problem with re-evaluating the hammers. But when we do so, we can forget the problems they were meant to solve. We become, in short, distracted. And there's an opportunity cost to this re-evaluation process, if it can even be called that, which is what we are not studying, what we have turned our attention away from in the name of political expediency. This is my concern. If we devoted at least as much energy and resource to existing vulnerabilities and emerging vulnerabilities in our financial sector, rather than to debating ad infinitum whether the tools need to be taken out of the hands of our designated policymakers, maybe there would be greater probability that we are indeed minimizing the costs of another crisis and downturn and creating the conditions that any such crisis and downturn will be short-lived. That is real financial and economic resilience, which, after all, is what we really need to assure. So I love this moniker, this rethinking regulation. I wish I had come up with that name. It suggests new ways of thinking about a term that has now been politicized to be associated with all that is anti-growth and anti-government and anti-American. And as a result, our financial regulatory system is not being given a fair shake. It is taking a beating as we speak. And in this process, we are losing imperfect but important tools. And we are being diverted from tackling the emergence of new risks. Maybe one facet of rethinking regulation is to recast it as the question of how to promote resilience, which is, after all, the promotion of a financial system that is strong enough to recover quickly, a financial system that has fewer costly cracks in its foundation. And in that way, it becomes a financial system that is stronger and better able to do what it's supposed to do for our economy. Let me stop there and thank you.
Thank you very much, Sarah. So we have time for discussion we have a variety of faculty and students and colleagues from across campus here. So, and we're also honored to have with us Joe Smith, former Financial Regulatory Commissioner for the state of North Carolina. And maybe I'll just ask the first question about reusing dental floss.
Yeah. It never was that bad.
Are there, with taking your point about the deeper vulnerabilities that we might be, from which we might be distracted or might be neglected, are there, do you think there are kinds of behaviors like reusing dental floss, but it might be something else, that were inculcated by the more recent financial crisis, that people have learned to behave in some way from the experience from 2007 or so to now, that we have yet to recognize that what we should be thinking about if we're going to prevent and ensure resilience from the next crisis?
Right. So this is fascinating to me because, of course, we thought that the economy was on a particular trajectory prior to the crisis. The crisis hits, you sink. You sink for a while, and then the assumption is that with the right response, you get the economy back on the exact same slope, the exact same trajectory that it was on before. It didn't work like that, and I think part of the reason it didn't work was because the crisis was so deep, and it took much longer than anybody had anticipated to turn around. The behaviors changed. That, in essence, what economists view as regular assumptions of behavior change. Now, what they are, what these changes were, have not been fully explored, but we know, for example, home ownership. I mean, if you look at the next generation of homeowners, they are not flocking to buy homes the way maybe we did. The idea of home ownership as this source of wealth is kind of now viewed as a mixed bag. So the home ownership rates were down, and household formation, which is a collected data point, saw dips, and questions were coming up as to, well, are we going to have people really turned sour towards buying a home because of what we've just experienced in terms of foreclosures and that sort of thing. So that's been one behavioral change. Another has been a distrust of banks. One thing that also did not happen as people would imagine is that, there would be, that there'd be a downturn in activity, but then once the economy kind of took off again, that people would use banks the way they had used them before. And guess what? We did not see that. I mean, we still have in our country, 1 out of every 4 American households being, unbanked or underbanked. And so that number has gotten larger since the financial crisis. So query as to whether that's been a behavioral change. And then there have been some maybe less micro observations, more macro observations, where certain economic rules haven't been performing as one would expect. So one rule of thumb that, macroeconomists look at a lot is Okun's law, right, which is the relationship between GDP growth and unemployment. And that typically, traditionally, had always worked in a fairly predictable way, right? So when GDP went up, unemployment went down, and it was fairly predictable. Now, of course, we haven't seen that relationship stand up anymore because, of course, unemployment has come way down, and GDP has not taken off in the commensurate way that you would expect would be associated with a drop in unemployment. So there have been, and I think underlying that are probably some behavioral changes that we haven't yet fully understood. But the point is that those changes sort of change your view as to how the economy works and affects the ability with which you can predict tools will have more or less the same degree of efficacy.
Thank you. So you're welcome to call on people, or I can. Maybe
sure.
each person, when you pose your question, just identify yourself.
Okay, Stephen Schwartz from the law school. So I enjoyed your comments, and I wanted to see if I can tie together your final point with Jonathan's question. Your final point was promote resiliency, and Jonathan's question was, of course, how did behaviors change? One thing that I think is almost inevitable is that if behaviors change, they'll change back again. And one of the concerns, I mean, you can look to what happened in the recent crisis, and there are stories that it parallels exactly what happened in the Great Depression. In both cases, for example, you had subprime lending by banks thinking they were over-collateralized, in one case by home prices, in the Great Depression by stock prices with margin loans. Turns out there was a dip. They become under-collateralized, and you're going to have that problem. It may not be housing as collateral, it may not be stock as collateral, it'll be something else, or it could be something we haven't envisioned at all. But the lesson, I think, is that it's going to be awfully hard to eliminate another crisis. And so, arguably, we need to try to make the financial system more resilient to withstand better another crisis. And I know that, financial engineers and others, and I've done some work on chaos theory and how we can redesign the financial system to create that modularity, knowing that a complex system is inevitably going to fail, and you want to have backups. And what is the Treasury or the Fed doing to begin to think about this? And in that context, let's look both at financial institutions, firms, which has been the focus, but also financial markets, because I think financial markets are increasingly critical as a funding source.
So I think I agree with a lot of that. I think the elimination of the business cycle is not one that anybody is imagining to be realistic. The point isn't here, I think, to eliminate the normal cyclicality. The goal really should be to minimize the period of time and the harms caused by any inevitable, potentially inevitable downturn that is so long and so deep that it creates real economic harm and alters really our trajectory for the longer term. In terms of this idea of building resiliency, building in mechanisms for assuring that our downturns are not so painful and destructive, really, in terms of the underlying engines of our economy. I can't comment on I don't know what the Fed is currently thinking about on that. I can tell you the Treasury is probably not thinking about it at all. But regulation actually has the potential to be framed, I think, in just the way you are thinking about. Instead of us confining ourselves to the box that we have all kind of blindly moved into, which is that regulation is something that is anti-growth, maybe we need to rethink regulation as something that is pro-resiliency, pro-sustainability. I think also that there is harm in kind of sputtering starts and stops. So in other words, if you asked me what is better for the economy, a slow and steady path towards greater growth, or a quick hit to growth and a subsequent collapse, I would take the former. So this idea of resiliency, sustainability, I think is an important one, and one in which I'm curious about, exploring and hearing, academics kind of develop a little bit more. Yes.
So we read in the press here that the industry, the financial industry, Jim Cox from the law school, industry arguments up on the Hill are along the lines that higher capital requirement restricts our limit lending, and these regulations burden our cost structure, so we're going to be able to raise capital, et cetera, and we can't pay the interest rates we want to like that. I wonder, I would assume that those arguments, I'm not a banking person, I would assume those arguments have been around for a while, but I just wonder what your own personal take are about those two main arguments that they're raising in terms of the conditions we're seeing, where the bank stocks are doing pretty well. They've certainly come back a long way, and they seem to have a lot of stability to themselves.
So thank you for that. I
thought I would tee it up for you.
Yeah, so the capital issue, I got to tell you, and Joe Smith is also, can weigh in on this. I am not sold on this trade-off between capital, higher capital levels and less lending. I don't see it. I mean, I just don't. The data hasn't shown that at all. So I don't buy this notion that that we have somehow, that our capital regulation has choked off lending. I don't see it in bank lending, business lending, even if you focus on community bank lending. I have not seen that happen. So from a data perspective, I say not there, okay? Now, this replacement to Dodd-Frank would do would be, in essence, to say, let's bump up capital to 10%, and if you bump your capital up to 10%, you can take off all the other regulatory restrictions that were contained in Dodd-Frank. I also don't believe that is a trade-off that is a meaningful one. First of all, capital levels right now, for the well-capitalized banks are between 6 and 8%. The bump up would be to 10%. A lot of banks are there already. I don't see quite why that extra 2% is going to be the magic amount that means that we don't need other supervisory mechanisms. I also think that capital and supervision, and by the way, I'm clearly not speaking for the Fed in this perspective, because I think there were plenty of Fed governors who believed that if you got, that capital was a substitute for other kind of on-site supervision. I am a huge fan of on-site supervision of banks. I do not see a trade-off between capital and these other types of supervisory mechanisms. So I don't buy the approach in the Dodd-Frank replacement. I don't buy this idea that capital is somehow choking off lending, and I am not at all persuaded by the increase in the equity prices of bank stocks right now. We had that same upsurge prior to the financial crisis, and we saw what that meant. So I'm curious about it, of course, and I, am very much, following, tying of events with what is happening in equity markets, but I do not find it to be an indicator of ultimate, safety and soundness in our banking sector. Do you want to add anything to that, Joe?
No, I think at least until recently, I think even now, loan demand hasn't exactly on the business side hasn't been outrageous. I mean, you got to have demand in the market before you got people wanting to borrow and buy. And I agree with you. I think capital levels, to the point actually, the community banks are famous, according to our dear friend Marty Grunberg, for lending to businesses. Well, their capital levels are already above this 10% as a rule. I mean, most community banks now have pretty high capital levels, in part because it's not much to do with it. So I think I agree with you about that. That's not the problem. I do think there's some issues about maybe fine tuning, but it's fine tuning. It's not replacing. Plus, it's never clear to me with them. Do they mean if you have a capital level, you don't have to do fair lending compliance anymore? I mean, I've never. That's like apples and pears.
Right.
That doesn't make any sense.
Right. Yes, sir.
David Banks, Department of Statistical Science. You said several nice things. First off, you have a list of what you see as vulnerabilities in the system. And I could easily imagine that rethinking regulation might like to take one or two of those and simply try and hammer out what we would ideally think would be a solution or an approach to addressing that specific vulnerability. It would be an academic exercise. It would have no consequence, but it would still be a fun thing for your group to do, Jonathan.
Why would we do that?
Although I would say, I like the suggestion. I don't view it as, it would be an academic exercise, but I think it would have real traction. I mean, in other words, that's really my point, is that those are the kind of questions that we need people who are not particularly don't have an ideological agenda here to try to study for us. And again, you may find nothing. You may find that I just made this up, but I didn't come up with this, in an academic way. I came up with it in having gone through the financial crisis and looked very closely at what different vulnerabilities still existed.
And this may lead me to my second question. As you described the situation in 2009, the people who had their hands on the wheels of government didn't know what to do. They didn't have a good working theory that said, well, these are the knobs we should turn, and this will be the consequence. And clearly there were some governments in Europe that guessed wrong and are still having enormous trouble. I think the United States managed to guess mostly right, and we managed to get through it. But it concerns me that we don't have a more principled understanding of the regulation of our economy. Should I blame economists or should I blame government?
Those are your only two choices.
Yeah, right.
Take the economists.
So I think it's important to realize that we are in the realm here of social science, okay? And I think the economists have taken us so far in terms of quantifying a lot of behaviors and a lot of tools that permit us to make predictions. I mean, we rely on regression analysis. We rely on models that have embedded in them particular assumptions for ease of moving the dialogue along. But you are exactly right that this is not science. This is not anything that I would say exists in a better form anywhere in the world. Again, I am, quite critical of what, regulators might have been doing in the movement towards the crisis. I am less critical of what they did to respond. Now, to me, the ultimate value would be as if we could figure out, and again, this goes to the resilience question, in the moving towards downturns, what can you do to build in the resilience when times are good that will minimize the chance of harms when times are bad. And I think there is space to blame government. There is space to blame economists, but you have to remember that we all are. I mean, we are all doing the best that with what we have, and I think this also gets to this idea of approaching things in an interdisciplinary way. Economists don't have all the answers, and government bureaucrats don't have all the answers. But if you can convene and imagine mechanisms where you're bringing together other perspectives, and that those perspectives are freely discussed and debated, I think that's pretty good. I think that would be something we should aim for, so that we understand kind of what it is we're up against and what kind of tools exist to help us get to better solutions.
Thank you.
Elizabeth Devontenay from law school. I say this as someone who's extremely pro-Fed, but I had two questions. One is, why does the Fed watch the market so closely? So, there's a camp that has worries that the Fed is too independent. There's another camp that worries that they're focused too much on sort of reactions in the stock market, that the stock market is always going to be upset every time you raise interest rates. Is that really your focus, that it's something that the Fed should pay attention to? And the second question is there any sense within the Fed that a big part of the impetus for the financial crisis was an asset bubble that was probably as a result of excessively low interest rates from the late 90s and the 2000s, and that, of course, you can have an asset bubble. If it doesn't hit the banks, then you're okay. So that connection was something not directly caused by the Fed, but is there a sense that interest rates were too low and that we should maybe be worrying about that again?
So two great questions. So I'll take them one by one. So the first one, why is the Fed so focused on markets? Coming into the Fed, I was like, oh my gosh, this is going to be all about focus on the markets. I was pleasantly surprised that it was not, as it is perceived to be, evidently, with a kind of monomaniacal focus on markets. It's not. But you do have to remember that the Fed's tool is a pretty blunt tool. It's just interest rates. It's also, regulatory policy, and that's a more recent, a recent invention for the Fed. But the main tool, the monetary policy tool, is interest rates. That is blunt. And how do interest rates move? They move through markets. Okay, it is not something that is going to affect immediately, like a household, the way a rule regarding a predatory lending rule might. Okay, it's the tools of monetary policy are blunt tools that move through markets. That's the nature of them. It's the primary tool being open market purchases and sales, and that's a market tool. And it's primarily through only one interest rate. It's the Fed funds rate, which again is a narrower market indicator, but again, markets matter. Now your point is well taken though, because ultimately it's not so much what the markets are doing, it's how those interest rates feed into real economic activity. So there's always a piece that comes after the market, understanding the market moves, and that is how did the market moves affect the real economy, which is the ultimate focus. And I can tell you, at least during my time there, that was the focus. It was just that you have to understand markets to understand how the tool is working. Your second question is asset bubbles, and whether there's appetite within the Fed to realize that low interest rates create asset bubbles. The answer is yes. I mean, there is a lively discussion, probably still going on, but clearly going on when I was there, about the effects of a prolonged period of low interest rates on the creation of asset bubbles. Now, I wouldn't say that everybody who talks about asset bubbles believes that the housing bubble, that the financial crisis was the result of a housing bubble. Some people are not. That's not their orientation towards the financial crisis. But this notion that long-term, that keeping interest rates low for so long, and it was a long time. Part of the reason was because, one, that's the only tool the Fed has, and two, primarily, and two, that the recession, it was taking a long time to recover. So interest rates were kept at the zero lower bound for a long time, longer than anybody had imagined. And hence, if you read FOMC transcripts, you will see dissenting views or even non-dissenting views, but questions about, this is getting us nervous. Do we see the creation of new bubbles emerging? Kind of, what we called chase for yield, right? Because yields were so low in terms of what the Fed was setting. Was it the sense, did we see activity where people were moving into riskier investments just to get more of a return? And those discussions were vibrant and very much part of the debates. And so, in short, yes, I mean, that is something, you think about. Again, I would probably quibble on the notion that it was low interest rates that caused the housing bubble. I mean, you're talking, again, to a regulator, and I kind of see maybe weak underwriting standards as being potentially more of a driver. But the idea of asset bubbles, definitely live discussion point. And it gets even more, it goes further than that, because then there are camps of thought regarding, do you use monetary policy to burst an asset bubble? It's not conventional that you would think that monetary policy should be used to stop the housing market from overheating. That is not universally accepted. People would say that is not what monetary policy was designed to do. So yes, there's discussions of asset bubbles, but then there are further distinctions on whether people think you do anything about it, or whether you use monetary policy to do anything about it.
Yes, over here.
Yes.
Hey, my name's John. I'm a student at Duke Law, so I don't really know why I'm asking a question after all my professors just did. But I was kind of curious, because you started off talking about how a lot of answers kind of seem to be in the middle of all these different disciplines kind of coming together, in the seams. And when you have the rise of these new financial technology products, or at least your time in cybersecurity, I imagine that at least a few times you were in a room with experts in those fields, and you probably were kind of I don't know what these people are talking about, but yet you have to regulate these activities. And so I was kind of curious about, do you think that as technology is kind of becoming more sophisticated and being implemented in different ways, and probably more prevalently, that the qualifications for being a regulator might be changing as well? Or do you think that to be a regulator, you don't necessarily need that deeper understanding of the underlying technology to do your job efficiently?
Oh, just an excellent question. And it's a really, good invitation to talk about kind of how we thought about doing cyber security. And you're exactly right. I mean, I clearly not an expert in understanding cybersecurity. So here I am at, the Treasury Department as the number 2, and I'm talking to bankers and other financial institution participants regularly and seeing numbers of hacks. I mean, they are experiencing hacks at a very, very prevalent rate. The hacks are changing, the vectors of attack change, and they, view this as an element of operational risk. This is something significant. So I'm having this discussion with them, and of course I realize immediately I am not an IT person. So what do you do? Okay, what do you do? Now you can take different approaches. You can say, not me, this isn't, not me, go somewhere else. Don't talk to me about this. This is not my purview. Or I could say, give me more resources. I can't do this without, that's not, to me, leadership. Okay, so what leadership is you gotta learn this. And you have to figure, and you have to admit, this isn't, okay, I am not an IT expert. But I do believe that people like me can understand this. Not only do I believe that I can understand it, I believe that others can understand it without an extensive IT background, and they have to understand it. So it was very interesting in the early days of doing cyber. Nobody wanted to, it was all the IT departments who were kind of bringing up these risks. It was all just IT people talking to IT people, and nobody understood the language. The C-suite completely didn't know what they were talking about, but knew they needed to understand this. So the first challenge I thought we had was breaking down the IT speak and putting it into a jargon that the C-suite can speak. Well, guess what? We know the C-suite jargon. Like, we know the jargon of risk management. We know how to talk in terms of risk. So the first task was taking the IT language and translating it into risk management language. And so we did that. It wasn't easy. I mean, it was not easy, and we subsequently, had to do that not just within Treasury, but we had to do it within all the with the entire regulatory apparatus, the Fed, the SEC, the CFTC, the FDIC. We had to bring everybody to the table on that. And by the way, when we brought everybody to the table on that, we didn't bring in the IT specialists. Okay, I insisted that it be the top person at every agency. So a lot of people are like, oh, the head of the CFTC, Tim Massett, he said to me, I don't know anything about cyber. He said, I'm not coming to your meeting. I said, oh, okay, Tim, that's fine. If you don't want to come, there will not be a seat for the CFTC at the meeting. Well, that's like all you have to do in government. You take away their seat, and then they get there. But anyway, he came. The point is, I wanted the top people in the agencies to be responsible not just for their own agency's cybersecurity, but for understanding the institutions that they regulated. They need to be able to talk about it. So if we kept it siloed within IT, it never would have gotten there. Subsequently, I realized, okay, cybersecurity is not just an issue for the U.S., it's a global issue. The internet has no bounds. So I used the same approach within the G7. So I didn't look for an IT, like a cyber home for this. I looked for a risk management home. So I found my counterparts in the G7 countries and did exactly the same thing. Assembled them and said, let's talk about cybersecurity from a risk management perspective. And that was how we moved the issue. Now, did I completely sideline IT? Absolutely not. I used this principle of bringing in different perspectives. So I actually unwittingly created better cybersecurity within Treasury because for the first time I had the IT folks talking to the policy folks. Like you would think, why doesn't that just happen automatically? It does not happen automatically. But by virtue of working on this sort of translation project, I brought everybody to the table. And it was, I have to say, it was just a fascinating process. Another example of how we had to do this. So the IRS is part of Treasury, technically, and there had been some hacks at IRS. And there's a group at the White House, no longer. There was a group at the White House called the U.S. Digital Service, USDS. And these were people who had come from Silicon Valley, and they weren't government people. To your point of like, you have to be government. Like they knew nothing about regulation, they knew nothing about working in government, but they wanted to help the country. They really wanted to serve in some way. So President Obama pulled together something called the U.S. Digital Service, and these were mostly young people from Silicon Valley who wanted to fix things in government, fix some of the vulnerabilities. So they came to me with a project, having to do with fixing something at the IRS. And incidentally, the person who headed U.S. Digital Service was a guy who, his name was just Mikey. His name was Mikey. I don't think he had a last, he was just Mikey, and he had a t-shirt and a baseball hat on backwards, and he was it. He was like the guy you who headed this up. So I said to Mikey, and really, I don't think he had a last name. That I would like to, that there was work to be done at the IRS, and so we created a model and a specific project where these U.S. digital service, like IT geeks, came in and worked with IRS so-called bureaucrats, the IRS IT team, okay, to in essence fix a particular problem. And there was a button on the IRS website called Get Transcript. You can actually get your transcript that shows all the transactions that have occurred between you and the IRS. And this was the button that we thought we needed to, there was a vulnerability in it. So the USDS team came in and fixed it. And it was fascinating to watch these two cultures talk to each other. So, the IRS, bureaucrat, they were very, very rule-based, very much this is how you have to do it. And the USDS team, they were doing things like they were working from their homes. Well, you just don't bring IRS code home. Like you do not do that. I mean, that contains personally identifiable information. That is, you would not do that. So I had heard this had happened, and I got on the phone with Mikey. I said, Mikey, you got to tell your guys they got to come in to the, they do have to work in an office. They can't work, they can't do this at home just because of this risk of code getting out there. And I realized that this was a useful discussion to be having. We were bridging disciplines. We were bridging cultures. And as I look back on this, as much of a headache as it was, it created a template for different disciplines to come together and work together. You don't want everybody being a cybersecurity expert. In fact, we did better not insisting that everybody be a cybersecurity expert. So if that helps answer your question, that's kind of how we approached it.
Thanks.
Lawrence Baxter, I think that's beautifully said, and it goes to a profoundly important cause of a lot of the problems we have, not only in regulation but in corporate governance. There is an assumption outside of one's discipline that other people who are expert in theirs will both know more than you can ever know and also be left to their devices. And you see this a lot with directors on boards. They say, well, that's the expert and so on. And it's the most dangerous thing you can possibly have because of a basic principle, which is if somebody can't say what they're doing out of their discipline in plain English, they don't understand what they're doing. No, any more than a surgeon who can't explain what some complex physiological and anatomical process means to the patient knows what they're doing. They may think they know what they're doing, but unless they can say it in plain English, they don't. And what happens is that you'll get people like board directors who will be afraid to ask because they feel like they may look stupid.
Right.
And they will comfort themselves by taking the view that, well, this is so complicated, I just got to leave it to the expert. And that's when you see the abdication of authority and responsibility by the... And it's no more, modern technology is complicated, but it was pretty complicated long ago too. It keeps on changing. We had a chief operating officer by the name of Georges. He was a brute, but he was an effective brute. In a meeting, he would make everybody introduce themselves at the table of what did they do for the company. And he got to a technologist at one point, and this technologist muttered and mumbled, and he said, I'm sorry, I don't understand that. So the technologist said it a bit more coherently. He said, I still don't understand it. He did it again. He said, I still don't understand it. He said, if you don't explain it to me so I understand it the next time, I'm going to ask you why you're with this company. It was brutal, but it was very effective. It would say, don't come to this meeting unless you can properly represent. Because we all have to make the value choices. It's not just the technologist or the engineer or the doctor or the lawyer. If we said to our clients, well, it's because of the parole evidence rule, that wouldn't be enough. We'd never accept that as proper lawyering. We'd explain to the client what that means. And that can be done in plain English.
That's beautifully stated, and it's actually necessary for government to be explaining what it's doing and why. So the exercise is not just an exercise necessary for board for board directors. It's really an exercise that government, in its broadest sense, has to take on board too. You have to be smart enough to understand the subject matter, but you have to be able to communicate it. It has to. If you have no buy-in, you're not going anywhere. Like you have marginalized, isolated yourself, and you are not going to be effective. So the communication piece and how this gets presented, to Professor Baxter's point, completely key. Yes.
Lee Reiners, Law School. So Sarah, thanks for coming. At the beginning of your remarks, you mentioned that perhaps being a Fed governor was a bit more pleasant experience than being Deputy Treasury Secretary. So I'd be interested in getting your thoughts on the differences between the culture at the two organizations, and then following up on that, the role of advocacy within both organizations. And as you mentioned, sort of regulations become such a politicized word nowadays. And there's a lot of people calling on Chair Yellen and others at the board to take more of an active role in sort of pushing back against some of the rhetoric coming out of the administration. And the Fed has clearly tried to be apolitical over the years, especially since Bernanke came on board. So curious your thoughts on that, if the Fed should perhaps be playing more of an active role in pushing back against some of the policy proposals that are out there.
So an excellent question. Of course, the primary distinction between the Fed and Treasury for me was that the Fed is an independent agency, and Treasury is part of the executive branch, part of the administration. And that turns out to have huge ramifications. And by the way, this is, as we rethink regulation, think about really what happened yesterday with Comey. The FBI is also an independent organization, and we ask ourselves, what is, should these agencies, should the Fed be independent? Is there a value to that independence? I come out having not been a particularly, I can't say I'm like a big Fed fan or anything like that, but I do think there is a role for independent agencies done well. Like, you still want your independent agencies to be accountable. You still want them to be speaking in English. I don't think Alan Greenspan spoke much English, but you want a good communicator at the helm, but you also want the space to talk about issues in a way that shields you a little bit from the harsh light of criticism, just for a little bit, because you all are in academia, and you probably take for granted that you can say pretty much what you want to say, look at the questions that you want to study, and it's not considered an overly political atmosphere. And that's good for us. We need questions looked at in a dispassionate way. You don't see that necessarily in executive branch agencies that are aligned with an administration. Now, it might not be an issue for you if you're well aligned with the views of the president, and then you obviously do your best to, promote those views within the purview of your agency. But the Fed is, I thought is really designed pretty well, from the sense of giving people the space to look at questions dispassionately. If you look at QE2, this was one of the most unorthodox monetary policy accommodation tools used. It had been developed in papers and models well before it was needed. I don't think anybody thought that they'd actually need to take them out of the drawer and use them, but they did. And the work had been done. And that's like pretty remarkable, that you would have a place that could actually start to understand new tools in case things got really bad. You could, sort of break the jar and take out the formulas. And that's unheard of, really, in government. It was not, I didn't find it particularly present at Treasury, even though at Treasury there is huge expertise. It was a very reactive organization. In other words, one day we were dealing with, sort of the Greece situation. Another day it was, the Italian banks. Another day it was, a cyber breach at at IRS. I mean, those kinds of issues constantly kept us on our toes, so we were not necessarily always able to do kind of the deep think that you need to do policy well. So I think that independence, if it's done right. Now, I'm not sure about the reserve bank structure, and I know I'm probably going to something close to your heart here, but I don't know how I feel about those reserve banks and their status. But speaking just in terms of the Board of Governors itself and how the Fed and the FOMC, I think it's important. And a more modern manifestation of this that's timely is the FSOC, right? The Financial Stability Oversight Council, which was created in Dodd-Frank to be a mechanism by which all the regulators would get together and talk about systemic risk. Again, the risk in the seams, what was happening in between the jurisdictions of the various agencies. And the meetings there, it was very interesting. Everybody clamored, these have to be public meetings. We got to be out there, talking to the public. When you put the regulators out to talk to the public, they read their notes. There's no discussions about asset bubbles or statistical methods, or those are not frank and candid discussions. So there is something to be said for doing things at least a little bit with the window shades down, so you can try to get some candid discussion and get some good solutions moving. And I think the Fed has pretty much done that balance well. But we want institutions in our government that are permitted to do that.
Could you just to follow up on that?
Yeah.
Say a little more about the FSOC and its function institutionally. What you thought its strengths and weaknesses have been in changing the way the government makes or supervises these financial regulatory policies?
Sure. So the FSOC, again, is a creature of the response to the financial crisis. And the idea here was that we live in we have a very fragmented regulatory system. Like, really? We have a Fed, we have an OCC, we have an FDIC, we have 50 state bank regulators, we have an SEC, a CFTC. Like, really? Like, we really need all of this? We can't do anything, we can't make this a little bit more rational, can't streamline? And there have been historical attempts over time to streamline. And one of the narratives emerging from the financial crisis was that some of the risks that were developing in our economy were not under the purview of any one single regulator. It was, again, in the seams. It was in between maybe what the SEC and the Fed did. And as a result, we were missing the relevant signals. So some people thought that Dodd-Frank would be a mechanism by which we rationalize the regulatory structure, where we get rid of agencies and put everything under one umbrella, two umbrellas. It didn't do that, right? It did get rid of the Office of Thrift Supervision, but then it created the Consumer Financial Protection Bureau. So we didn't have any net reduction in the number of agencies. But as a result, it was recognized, and I think correctly, that if we're going to keep the same structure, we better have a mechanism of coordination. We better have a mechanism by which the regulators are talking to each other regularly so that they can compare notes on what they are seeing and what they're looking at and what they're not looking at, so that somebody else can pick it up and say, okay, well, let me take that on, or maybe that's something that we are not concerned about. And this is the idea of systemic risk, right? It exists in the seams, and it has the ability to propagate through the system. So this was the genesis of the Financial Stability Oversight Council, which is chaired by Treasury. Some people have argued that is inappropriate because Treasury is not an independent agency, but Treasury is the chair, and it is populated by the heads of every federal financial regulator, as well as a representative from insurance, from the states, from the state securities administrators. So it really attempts to be comprehensive, and this is the FSOC, and this is now also incidentally slated for weakening in the new Dodd-Frank proposed repeal. Again, I think a mistake, an accident waiting to happen. Again, is this perfect coordination? No, these are still, we're still human beings, but what are we going to do? What are we going to do to replace that perspective? I'd like to know. If there were some viable substitute, maybe we could debate it, but to just eliminate it or weaken it, I think is a dangerous step.
I had a question. You had mentioned...
Sarah, could you just identify yourself?
Sarah Green from the law school. You had mentioned that at Treasury you worked on the student loan crisis a bit, but you also just said that a lot of what you were doing at Treasury was reactive and this came up. So I'm wondering, one, how did student loans come to be an issue that Treasury was interested in as opposed to like Consumer Protection Financial Bureau? Two, how bad is it? Because there are all these articles that some are saying this is the next big crisis. Some are saying it's not as bad as we think. And so from your experience, where is that going?
Great, thank you. So this notion that Treasury is more reactive is definitely true. And I knew that actually coming into the role, so much so that one of my conditions in coming into the role, because I was leaving a place that I generally liked, one of my conditions was, there are going to be certain areas that I am going to want to give some real thought to, and I'm going to want to assemble cross-Treasury teams to tackle, and that's just going to be what I want to do. And one of those issues was cybersecurity, and the other was student loan debt. And the student loan debt, the contours of that, recall, we were seeing after the crisis yet another potential bubble, this time though with federal student loans. The balance sheet for federal student loans now exceeds $1.7 trillion. And I wanted to ask our economists, and I wanted to ask others, is this a problem? At the same time, we started seeing defaults and delinquencies start to tick up. So the first thing to do was I wanted to monitor it. We didn't have nobody was monitoring it. The education department wasn't monitoring it. The private student loan market, there was nothing, it just wasn't being monitored. So I just was like, can we just put some rigor around what's happening here? So we started doing that, and it was interesting. This was an issue. I got a lot of people definitely wanted to join in on looking at the student loan debt issues. And so began really monitoring, collecting the right, not asking for data, but internally compiling what we had and trying to figure out what was going on. And it was a pretty remarkable process, because I certainly went in thinking this could be the next thing. This could be it. I didn't see though the connectivity point that would have suggested a contagion, but I kept looking, and I think we always have to keep looking. And I found other things though that completely concerned me, having to do with the uptick in delinquencies. So what we then did was segregate. We tried to figure out what part of the balance sheet, what kind of schools, what's going on here, where are the delinquencies and defaults centered? And we found them centered in, this took a while to get to, but the for-profit schools. And so then that became a mechanism to start thinking about what is it about the for-profit schools that differs from other schools, and started looking at the behaviors associated with why people go to the for-profit schools. And then to your very, exemplary methods of data collection yourself, I started having conversations with student groups around the country. So anytime I was in a city, I would, tack on a visit to a community college or a public university or a private school, and talk to students to try to figure this out. And that was extremely enriching, because what I learned from talking to students was that there was this amazing disconnect between what, at least what the Obama administration was trying to do to make student loan payments more affordable, and what students knew were out there. And to go to this question of like connectivity between, like, what is this, you got this idea from the student loan, from the financial crisis? The financial crisis, I looked at servicers. Servicers also play a role in the student loan debt market, and hence we have expertise like Joe Smith, who has done extensive work with servicing, monitoring servicers in the housing context, and then was brought over to education to look at the same issues, analogous issues in the student loan debt context. So, so the fault lines are there, and I argue have not been fully addressed, and at this point I argue are moving in the wrong direction. Yes?
I have two questions. One, what's the future of
Excuse me, could you say who you are?
Omar Perez, I'm a student.
Great, thanks.
What's the future of Dodd-Frank under the new administration, and as well, in terms of being a preventative measure for the next inevitable recession, could prosecuting bankers actually help that? Like, because Iceland has one of the fastest, right now, I think, has one of the fastest recovery rates for a recession, because they've let their top 3 banks actually fail, and at the same time, they actually, like, arrest bankers. So I was wondering, is that, like, feasible, possible, like, is that even going to work? Is that a thing?
Okay, I don't think I have an answer to the, I wasn't aware that the arresting bankers actually promoted a recovery. That's interesting. I will look at that. I mean, I have to say I have not made that connection in my own mind, except for the fact that, let's take it as true. Maybe the mechanism is that sort of the trust and confidence transmission channel of an economic recovery is enhanced or widened by the sense that the public feels that justice has been done. So maybe part of the financial crisis, well, it was the case that a lot of the financial crisis was that the downturn was exacerbated by the fact that there was a real loss of trust and confidence in government, but in the financial sector as well. And maybe that loss of confidence could have been reversed if people had felt in our country that we were putting bankers in jail. Maybe, and that might be the connection. Yes, and then we'll go back to your first question.
As a statistician, I'm contractually obliged to tell you that causation and correlation does not imply causation. So the fact that they are arresting bankers may have nothing to do with the swift recovery.
Yeah, I think disaffirming the CDs did more to help them than, just saying they wouldn't pay the bank's debts had more to do with the recovery than putting people in jail, frankly.
Is there a study that you got that from?
No, it was just like an idea to put out there, because I mean, there were people who were like at fault, but I don't think that they were held accountable for their actions in a way where it kind of it's kind of like a slap on the wrist actually with banks. So I feel like there needs to be more jurisdiction on their behalf.
Now, Mr. Whitney got put into jail in the Great Depression. Charlie Keating got put to jail in the S&L crisis. I mean, it's possible, and I will tell you, this is your show. I don't want to.
No, go for it.
She sent me on this crazy mission to try to help student loans out, and I failed, and you're kind not to say so. But in Boston, Massachusetts, with the Attorney General of Massachusetts and the Secretary of Education of the United States pointing out how we were giving students relief, the first question out of the audience, this is student loans, was, when does somebody go to jail? So there's apparently this deep-seated, what Geithner called Old Testament gene that's there that just requires a sacrifice. I actually think the thing to do is to find some old person or some person with terminal cancer or something and have them say, I caused the crisis, and then string it up in public, and then everybody will feel better. But I will tell you that, not to make too much light of it, all the mortgage work we did, the same thing. The fact that people didn't go to jail made everything else we did suspect, right? I mean, the fact that no one was punished. Now, the fact that if you started putting people in jail or started working up the food chain in banks during the bottom of a recession when there was still a financial crisis and terrified everybody to the point of inactivity, that wouldn't have helped economic recovery. It's just an opinion.
Mm-hmm. But it's an excellent. I mean, I think you're touching the nerve on why it is that I think people are so alienated from the from the regulatory response to Dodd-Frank. That the part of Dodd-Frank that resonates most with people is the CFPB. If you ask people what's in, I mean, Dodd-Frank was like a 1,500-page document, and if you ask people like, what did Dodd-Frank do? They're like, oh, created a Consumer Protection Bureau. That's it. That's what they know. That's what came out. That's what resonates with people. And I think this idea about how come nobody went to jail is a pretty strong,
it's huge.
Strong one. But then,
it's huge.
What's your view as to why people didn't go to jail?
My view? You'd have to ask Mr. General Holder. I think a piece of, well, first of all, there's a question, there's a thing called due process. You'd have to find out that they were literally and actually responsible in some criminal way. Maybe they were. But again, my main thing is this. At the end of it all, we've put people in jail before. Richard Whitney was chair of the New York Stock Exchange and was guilty. You're the expert, but he went to jail. And maybe that, I think people think World War II got us out of the Depression, not Whitney going to jail. And the other question is, in a big organization, how many people you put in jail? I mean, you put the whole management structure of a company in jail, so you got a $1 trillion bank, you're going to take the C-suite and send them all to the slammer. Well, that's interesting. What now? And so, I think ultimately what you're really saying is what you got to do is do the Swedish thing, not Iceland, which is have the government literally take it over, welcome to the post office, and right, and then you kick the people out and put new people in. But that is a breathtaking exercise of governmental authority. So I don't know the answer. The answer is I don't think the people in justice were such idiots they couldn't find a reason. If they had every reason to indict people and they didn't do it. And I don't think it was just because I don't know.
Well, I've actually done a major study came out last year on why people didn't go to jail, and if anyone's interested, I'd be happy to send it to you. But it had to do with a lot of factors, including that there wasn't that much resources among the prosecutors that are all devoted to terrorism, for example. A lot of the money was there, and it was much easier to prosecute, essentially civilly prosecute the companies.
Right.
It was also very, very hard to get criminal convictions of individuals. On the few cases that they basically tried to do it, what happened was the jury said no, because they felt it wasn't the people at the mid-level who actually may have done something wrong. It was the most senior people who were not aware of it, and the jury didn't want to convict the younger people. So the whole combination of things.
Fascinating. How many, what was your time period for studying that?
I studied it from about 2007 until 2013 or 2014.
Mm-hmm. Excellent. Good work.
I would go even further out on a limb and say the reason people didn't go to jail is because they didn't commit crimes. And that's a very unpolitically correct thing to say, but the fact is they didn't. The people who did commit crimes went to jail, and one of the lingering public perceptions is that many thousands should have gone to jail because they did in the savings and loan crisis, 1,100. But they committed crimes. They committed real crimes. And you can go back and look at the records, and they were easily provable crimes, going all the way up to the fellow who had American Continental. Most of the really bad things that people did, and they agreed in that in Wall Street, you wouldn't get even a criminal law professor to be able to put that together as a crime. And that's why they couldn't get convictions. And what Stevens just said is right about the sympathy of the jury for lower level bankers. They're not going to let them be the fall guys, although we've done that with a lot of the traders. We've certainly, Goldman Sachs handed Fabulous Fab over as a fall guy when in fact it's the Goldman Sachs system that was causing what he was doing. But what the system was doing was not a crime.
Yeah. No, I agree with that.
Very
I mean,
hard to
for the
accept
most
that.
part, although there were some.
Yeah, occasionally, and
Yeah.
sure, and but you know the other thing was that the fellow who was the CEO of Washington Mutual, they tried to. There were lots of resources thrown at that, and they still couldn't prove it because the decision making in big companies is fragmented.
Yeah.
It is all driven by the momentum of the business, bad judgment calls, a lot of ex post wisdom, and so on. And I've challenged people to say, give me one name of somebody who should have gone to jail and I've never been given a name. It's just that we had this need that Joe said to let's get a lamb out there, put it on the altar, and kill it, so we'll all feel a lot better.
Well, that's what happened in Enron. And if any, I doubt if any of those people deserve to go to jail, other than possibly.
They were nasty people, and they were arrogant, and they were
But they
merciless, and
weren't
so
illegal.
on. But I'd like somebody to give me one name of somebody who should have gone to jail.
If I could say, Sarah, to redeem myself slightly.
Too late.
Yeah, probably. No, I think there need to be penalties. The question is, what is the appropriate penalty to be able to level to vindicate the public need for retribution, which is really one theory of punishment, right? But I honestly think, and that's a hard one to figure out. Criminally indicting a bank, by the way, in most places ends its business. It's ended. They lose a criminal conviction of a bank results in the withdrawal of its charter. I mean, you can't.
A bank or a CEO?
A bank. And there are people who've thought about indicting. Prosecutors are brilliant in the theories they spin. I mean, it's possible. It's a person, right? Got constitutional rights and freedom of religion and stuff. So, but well, you do. You can incorporate yourself to get the Bill of Rights protection. So the question is what to do. The problem is you can't get the populace, public support and trust, which is important. I mean, to your point, people do not trust what we did because of this very point you've raised. But no one trusts anything less, apparently, than blood, a literal hanging. I mean, really, perp walk, all that stuff.
Mm-hmm. And to your earlier question, and I think we've kind of answered it obliquely, which is the prospects for Dodd-Frank to be repealed. You saw that the House Financial Services Committee voted out of their committee on party lines to replace Dodd-Frank with this, I think they're calling it Choice 2.0.
Yeah.
Yes, Choice 2.0.
Choice is good.
Yeah, well, choice is always good. So how can this be bad? And that bill, I think, is supported by the White House. And it will move to the House floor. And of course, it takes two chambers to pass a bill. So we'll see. My sense is it'll pass on the House floor because the majority there. Again, this has become partisan, right? Regulation has become partisan, so it will pass with a Republican vote, and then something will have to happen on the Senate side, and the Senate is also controlled by Republicans right now, so it may move through that body as well. It's interesting. Unlike healthcare, which is turning out to be much harder to repeal the Affordable Care Act than the White House, I think, originally thought. That touches people in a way financial regulation does not. I mean, so you do have a lot of people who are able to relate to the idea of what about pre-existing conditions? What are we, do I lose my coverage? I mean, it's a very visceral kind of discussion that the populace can have. We've always been challenged in the financial policy realm to have those kinds of discussions. There is, as Sarah will point out, there's stigma attached to a lot of, to being a debtor. There's stigma attached to being on the lower side of the income and wealth distribution, and it makes conversations harder in the financial realm. And then I think coupled with this idea that nobody was punished, I think people are it might just be a big yawn, the repeal of Dodd-Frank. It just might be. I think that's wrong, and I think, you know, for people who care about regulation, we need to figure out how to engage people on why the safeguards that were put in place in Dodd-Frank, not all of them. And again, I don't want to be held up here as, you know, defending it as perfection, but this notion that there are safeguards, why, in essence, we are going to be taking them down right now. Why? Like, what exactly is the reason? It's certainly not because of bank lending, because bank lending has not been affected. So, anyway, that's my instinct anyway on the first part of your question.
Can I follow up on all this to ask you about some other features and also connect back to your point about risk management in the C-suite, that senior leadership people in private sector and maybe in government too, they know how to talk about risk management. And so so broadening from criminal penalties for top officials, are there other kinds of ways of influencing the risk management choices that become the way the firm does business, the systemic operation of the firm, or I'm using systemic in a firm scale there, but or of the systemically the whole economy. So people have talked about the 2008 financial crisis arising from some poor judgments in risk management, including the packaging of mortgage-backed securities that included a lot of bad loans, and maybe that was facilitated by the ratings agencies mislabeling those loans. But why were the ratings agencies doing that? Competition with each other because they're paid by the issuers, various hypotheses. And simultaneously, why would the large investors be backing those vehicles? And maybe there's some aspects of the relief that they expected if there were a systemic downturn, so too big to fail, or other the prospects that the low probability but dire consequence risks would be shielded or buffered by government relief. So I don't know if you have, and there are further aspects too. For example, what the incentives of mid-level people to earn their bonuses quickly and then move on by the time the risk comes home to roost. And so what? And I think we were talking yesterday about the difficulties of information about risk within large organizations. So do you have thoughts on any of those aspects? And you don't have to comment on all of them, because there's so many proliferating features of this, but how can risk management work better?
Yeah, so one way it works better is through enforcement. In other words, there has to be follow-up to what regulators and examiners are suggesting need improvement. And we have to, that follow-up needs to entail what I would argue would be an escalating set of enforcement responses that get more and more draconian as performance and adherence to those regulatory findings lapses. So I think enforcement is one approach. And you also touch on this sort of timing problem that, you know, you want to incentivize better behavior, but a lot of times the people who have caused the bad behavior are gone. Well, what about changing compensation and clawback and doing some kind of clawback, which this was something that we had very much keyed up. It was required actually by Dodd-Frank to be looking at the compensation mechanisms and whether they were contributing to risk taking, because they do.
Yeah, but Dodd-Frank only did it for the very senior officers, and the people really who were advising these firms to invest in this stuff were the mid-level people, the technocrats essentially, and the vice presidents. Dodd-Frank really ignored them, and that was, I think,
yeah, I'll have to look at that again, Steve. I thought that I think that that's kind of how the regulators interpreted what Dodd-Frank did, but I thought that the Dodd-Frank directive had to do with incentive comp And then the regulators had to determine, okay, where do we cut the line? How far down the chain do we go? I think there was, and I'll look again.
Okay, yeah.
Yeah, it could be.
That's not my recollection,
okay,
but you could be right.
Right, but regardless, it wasn't done.
Yeah.
It wasn't done, okay? I mean, this was like this just was not done. So this, there's enforcement, and that's one piece. But how about just doing what Congress told you to do, which is to create some rules regarding incentive comp because of a finding that large salary and bonus payments encourage particular kinds of risk-taking, and we want to curb that risk-taking. That was something that was one of the features of the financial crisis. Not done.
Yeah.
And we can analyze why. I mean, there was this again goes to our regulatory structure. Like all these regulators had to sign off. Like we were, first of all, Treasury had no role in this, but I was trying to get this, trying to push them to get things done. You had the Fed, the FDIC, OCC, everybody was on board. They said, oh, not this SEC. SEC, they fell off. Okay, so let's try to get the SEC back in the tent. So then you get the SEC back in the tent. Whoops, the Fed just fell off. So there's no, and by the way, there was a deadline too. There was a deadline for this. So, again, enforcement, how about following what Congress has required you to do by putting in a rule in the first place? So I think there are definitely dimensions here that we did not go into extensively, but that are also relevant to a meaningful regulatory apparatus in the financial sector.
Mercy Domeno, PhD candidate in public policy. So returning to this idea that there were some sort of key lessons from the financial crisis, which we may or may not be remembering under the sort of Choice 2.0 or whatever the new regulatory framework is. And the idea that one of those lessons was if you have risk that is sort of prolific at the system level, but you have a fragmented regulatory system, that you need some mechanism for coordination. So you talked about the role of FSOC. I'm wondering though, with both your experience and then also your thoughts going forward about how international regulatory coordination and finance will work. Of course, there's been some movements to kind of put a chilling effect, I would say, on the role of Treasury and Fed in interacting with international institutions. So you mentioned some successes with the G7, but I'm wondering about with FSB and with BCBS. Do you think, will the U.S. continue to play a really prominent role? If it doesn't, will those institutions continue to be effective?
It's a great question, and the role of the U.S. in international financial regulation has always been really important. I mean, you want to participate, but you also want to lead, because we do have a very fulsome sense of what constitutes good regulation. Despite all the fault lines and stuff that we've talked about, we are actually considered quite advanced in terms of our understanding of creating an optimal regulatory apparatus as it compares to what happens in many other countries. So we traditionally have wanted to lead those discussions, and my sense is the same as yours. I see that there have been a lot of signals that the U.S. is not going to be encouraged to play in that space anymore. By the way, this is again, maybe some consolation to having an independent Fed. The Fed will continue, I think, in those discussions. But I have noticed there is a chilling effect, and even for agencies that there have not been direct attacks on, people are definitely lowering their heads. They do not want to be noticed. They certainly don't want to raise their hands and talk about internal problems within the agency or policy-oriented problems. I hate to be conspiratorial, but the FDIC used to have an advisory board that actually brought in academics and brought in others to talk about, I think, systemic risk resolution. Meetings canceled. Okay, now that could be nothing, but we would never cancel those meetings, because that was the opportunity to bring in, to get the latest academic thought and perspective on this. So, and you also have to remember that a lot of government people who work in government, they're not always, the civil servants are not always the most risk-taking to begin with. So you put in place sort of tone from the top that is one of disdain and one that we're going to cause trouble if you try to do something that steps out of line. And you do have effects. And I think they have yet to fully emerge, but I think they're troubling. Again, from the basic, my basic premise is that, you don't do policy making well if you don't conduct it in a candid and open and bring in as many perspectives as you can.
Do you sense in that respect that the big banks can't like what's happening because they need international, they need to be able to get into other markets? Is it possible that the very thing that we despise most, which is their enormous power of influence, might actually work for good this way to stop that nonsense? The Choice Act is clearly, at one level it's big money, but at another, and community banking, at another level it's got to be bad news for the big banks, because the last thing you want is Europe and Basel saying, all right, if you aren't going to play by, and they've already made those warnings, if you don't play by our rules, you're not playing in our economy. That's a disaster for them.
That's fine, Lawrence, but you're assuming that that Basel and the sort of international regulators are going to do something more stringent than what we have here.
Well, the banks would be in non-compliance, for example.
Or not. What if they just completely? I mean, we can't assume that what is happening abroad, from a regulatory perspective, is any less deregulatory than what's happening here.
Not so much in Europe, maybe in Britain, but even Britain, I think, starting to realize that they went too far. So I saw a speech must have been about a week ago, one of the senior European banking commissioners saying if US banks are exempted from these basic standards that we require, they will cease to be eligible. Now, of course, he can't make that happen overnight. But if I were Jamie Dimon, I wouldn't want to be hearing those noises, because the whole thrust, even of Basel itself, has been to open markets up to the US and the British banks. It can't be good for business.
It can't be, but I guess I'm not sure
they're
really going to follow through.
Well, it may be why Dimon is making speeches now more like a sort of leader than just a banker.
There is something, though, the other thing, though, I have noticed is that Dodd-Frank actually was, in many respects, it was very good for the big banks.
Yeah.
I think your point on that is well taken, because they actually invested quite a bit in compliance with the Volcker rule, for example. So query as to why, and it gives them a competitive advantage. Like, really, do they really want to now take take those restraint? They invested in systems that gave them a certain advantage. Would they really want that investment to become worthless and to also become a mechanism by which their so-called competitors could kind of do exactly what they're doing?
And FSOC, essentially, that whole structure gave them TBTF forever. Okay, they're identified as they're going to have to be bailed out if something goes wrong, so they can borrow at lower rates and so on. They deny all that, but there are plenty of studies showing that they in fact do get a subsidy because of that.
The studies, I recently looked at all those studies. They show there's a correlation of the big banks, but there is not, as our statisticians say, the correlation is not causation there. And in fact, all of the rate subsidies in all of the studies could be attributed to other factors such as size and economies of scale and scope.
I know that's what they say, but that's not what Moody's and Standard & Poor's do when they rate them. They say specifically the too big to fail subsidy is what matters. So yeah, there may not be any provable causation, but it's close enough for me.
And there was, is it correct that there was further consolidation in the banking sector since 2007, 2008, right? So partly and that could be also driven by the cost of complying with enhanced regulatory standards, or are there other features?
There are other features. I mean, a lot of community banks actually merged or shut their doors for other reasons, a lot having to do with finding successor CEOs to run these institutions. Some of them just did not find successors or have a succession plan that would have kept them in business. So it's hard to disentangle the extent to which it's the cost of regulation that and by the way, this was a trend underway before the financial crisis. So it wasn't just, I think your point would be stronger if we knew that it somehow accelerated after the financial crisis, but we did not see that. But you are right that there has been consolidation, but we can't attribute it to the cost of compliance.
I was just asking really rather than trying to make a point. We have any one last question?
Joe makes provocative points. Under what circumstances, given the Sweden example, would it make sense to treat banking as a utility and regulate it thusly?
That's a good question. In fact, the great case of Eureka Bank discusses that indirectly. You can read it on Lee's website, our case study. There's always been this issue, right, about whether banking is a utility, part of the financial infrastructure that is necessary, like the electric grid and everything else, or whether it's business. And the answer is yes. and Wells Fargo, you can argue, got in trouble. We don't want to get this another rabbit trail. We don't have time to go down, but they call their branches stores. They had a totally mercantile view, or a very mercantile view of what they were doing.